Intraday Winning Deal YouTube channel welcomes you all. Now we are going to see about the simple rules of investing. Trading investments is a sacred term for individuals. For many, investing means a kind of compulsory savings from one's earnings and getting lump sum money later. However, there is a lot more to investing than just that. Investing falls within a broader gamut of financial planning. It requires considerable thought and groundwork. Here, we have outlined some important guidelines to be borne in mind while planning your finances. Set your objectives. If you want to reach your personal and financial objectives, first you must define what they are. Ask yourself where you want to be in 5, 10, 20 years' time. Be specific, put some dollar figures beside each goal and then start planning how you will get there. We can assist you in your goal setting and in mapping out a strategy to achieve your goals. 1. The genius of compounding. Albert Einstein said compound interest was man's most powerful discovery, but it doesn't take a genius to put it into practice. Compound interest means you not only receive interest on the money you invest but interest on your interest. Over time, this simple concept becomes a powerful wealth creation tool. Say you invest $10,000 today at 5%, with all interest reinvested, it will grow to $27,126 in 20 years. Now look what happens if you spend your interest payments, earning what is called simple interest. Your $10,000 will earn $500 a year and will be worth just $20,000 in 20 years. That's the genius of Australia's superannuation system, which locks away your savings and all investment earnings until you retire. 2. Take your time. We all know we should take an active interest in our super and other investments, but is there such a thing as too much interest? Yes, according to a study by U.S. fund manager, Fidelity Investments. A review of clients over a decade found the best performing accounts were for investors who were dead. Next best were investors who had forgotten they had accounts. The thing both groups had in common was that they were not actively trying to time the market. A landmark study of 66,000 investors by the University of California reached a similar conclusion. The most active investors underperformed the overall share market return by 6.5% a year, leading the researchers to conclude trading is hazardous to your wealth too. The lesson is, be patient and stick to your plan. 3. Reduce risk with diversification. Shares, property, bonds and cash all have good years and bad. Even though shares and property provide the best growth in the long term, prices can fall or move sideways for years at a time and you don't want to be forced to sell in a downturn because you need the cash. The way to reduce the risk of crystallizing losses or losing everything on one investment is to diversify across and within asset classes. The right mix will depend on the timing of your goals and your risk tolerance. Think about investments that provide capital growth in the long run and income when you need it, from bank deposits, bonds, share dividends or rental income from investment property. 4. Follow the cycle, not the herd. When you take a long-term perspective, and have clear investment goals, it's easier to sit back and watch market cycles unfold. Then when you see an opportunity to buy quality assets at a low price, or sell an investment that no longer meets your objectives at a high one, you can pounce. Investors who panicked during the GFC and switched out of shares into cash and bonds would have done better to sit tight and ride out the volatility. And investors who took the opportunity to top up their holdings when the market was gripped by pessimism would have done even better. 5. Do your homework. Before investing your money, ensure that you have done your homework well. It is normal for sales pitches to be aggressive. Most sales executives are mainly interested in commission earned or business garnered, which reflects in their monthly targets. That is why one only gets to hear the best case scenario from agents, sales executives. A lot of sales agents, consultants try to exploit the individual's vulnerability and lack of knowledge while making a sales pitch. For instance, How else can you explain so many individuals in the low-risk category investing in high-risk HULAPs? Or why term plans, in spite of being the cheapest form of insurance, are still not bought by most individuals? Or why mutual fund IPOs find so much favor with investors even when there is no fit in their portfolios? One should understand his own profile in terms of income, risk appetite and future plans, and only then make investments in tune with the same. Individuals need to know what benefits different products offer and how they fit into their financial portfolios before taking a call on investing in them. You must listen to advice from different quarters, but the final decision should rest with you alone after a careful analysis. After all, it's your own hard-earned money. 6. Keep your eyes and ears open. Keep your eyes and ears open at all times for any investment opportunity that comes your way. The opportunity could be by way of changing market scenario or new product launches. Individuals shouldn't lose out on any opportunity just because they didn't know it existed. Of course, this involves a bit of updating yourself with latest product trends, market conditions and changing economic scenario. This way, you will not be completely at the mercy of the consultant, agent to provide you with investment-related information and solutions. 7. Involve yourself. While buying any financial product, ensure that you have involved yourself at critical stages. For example, while taking life insurance, see to it that you personally fill all the details in the proposal form. Insurance agents many a times used to, themselves, fill up details like the height and weight of the insured, his age and medical history among other things, based solely on their own judgment. They merely asked the individual to sign on the form at the end. What individuals don't realize is that this can lead to rejection of claims at a later stage if discrepancies are found in the proposal form. The insurance company cannot be faulted for rejecting such a claim. It is a shortcoming on the agent's part, who should have requested you to fill the form yourself, else fill it himself after verifying your details. All the necessary medical tests should also be diligently given. As mentioned earlier, any false claims might lead to rejections at a later date. 8. Inform your near and dear ones. This is especially true in case of life insurance. Inform your near and dear ones as soon as the policy is bought. If your spouse and/or parents know that you have a life insurance cover wherein they are nominees, they will be better placed to follow up with the life insurance company for the claim proceed should something happen to you. Typically, life insurance should not be so sacred that you don't broach the topic in the family. All related and affected parties must know exactly what needs to be done in your absence. 9. Maintain a logbook. Always maintain a logbook of your life insurance policies, investments. Individuals can and do have a variety of investments ranging from life insurance, endowment, term plan, HULAPs, to mutual funds and PPF/NSCs. A logbook should contain details about the same. Over an extended period of time, it becomes difficult for one to remember or track investment details like maturity date, maturity value and rate of interest. This logbook will take care of that problem. Of course, it goes without saying that for the logbook to be really effective and useful, it should be updated periodically to reflect investments and redemptions. This logbook should also include details of an individual's liabilities like home loans, personal loans, the amount outstanding on such loans, the ME and business liabilities, in case the individual runs a business, among others. Details of the logbook should also be shared with your dependents, spouse, children, parents. An important reason for making a copy is, in case of an unfortunate eventuality, the spouse knows her exact financial status. Also, one wouldn't want someone to come out of nowhere one fine day and stake a claim on the family's assets based on some fictitious liability. Trade at your own risk. Thank you. Intraday Winning Deal YouTube channel. Wish you happy life. Kindly subscribe to our channel to get daily updates.